Goldman Sachs chief U.S. equity strategist David Kostin joins us on set. It's great to see you.
Nice to see you, Sarah.
Anything here change your view? You're what, 4,000 for the S&P, which is basically what we are. Are you monitoring the May and the June rate hike probabilities to help determine what to do with stocks?
Sarah, what matters is what the market prices. And in the equity market is already pricing the idea the economy is pretty strong. Why do I make that conversation? Because cyclicals relative to defensive stocks would imply an ISM closer to 54. The last reading was around 47, 48. And so the equity market has already embraced the view that the economy is continuing to grow. I was just visiting clients in Asia. They broadly are of the view, in line with ourselves, that the market is essentially flat and fully pricing in the equity market the idea of the economy doing pretty well. I call it the four no's. You got no recession that's imminent. You got no earnings growth. You have no change in valuation, and you have no net money flow into the market. And that basically would drive a view that the market is basically fully priced at around 4,000.
It also drives the view that the Fed has more work to do. And that's what we just got from Fed Chair Powell's testimony, that they could speed up hikes, that they could go higher for longer if the data warrants. And if that's the case, doesn't that ultimately pressure the market multiple?
Well, many investors are anticipating already that the Fed could be tightening as high as 6%. Now, Goldman Sachs economics view is probably 5.5%. Obviously, there's a risk to the upside to that. But that's, I think, already priced largely into the equity market. Basically, that's anticipated. Much of the conversation with investors is about how companies are going to prioritize their spending. And the idea of companies continuing to buy back stock, pay dividends, that is what gets rewarded historically in an economy that is slowing. Not a recession, but it's slowing. And that's what Fed would be, trying to do, slow the economy, get inflation corralled. And that's sort of consistent. And the market's generally pricing that right now.
Speaking of companies, Dick's Sporting Goods was out with results earlier this morning. I had a chance to talk to Ed Stack, who's the chairman of Dick's. He was the former CEO. He's still there, very much executive chairman, I think is the title. We talked about, first of all, they're doubling their dividend, to your point, today. Really strong sales growth. Look at the move in the stock today. We talked about the consumer. He says no sign of a slowdown. He sees his consumers very resilient, although he says his category is a little less discretionary than people think. You need higher size soccer cleats for your daughter who's grown, then you're going to buy that no matter what's happening with the economy. So here's what he said. Good shape. And then very interesting, David, I wanted to run this by you. On inflation, he doesn't see any higher prices coming in their categories for the rest of the year. It doesn't mean the prices are coming down, but they're not going up anymore. And he said the supply chain is fixed.
Well, it's interesting. Last night we had dinner with 20 directors of independent public companies, and the discussion was pretty wide-ranging, went on for a long time. And one of the topics, to your point, was about the consumer and the sort of separation between the higher income versus the lower income consumer, and what what companies were seeing in terms of their spending. Saw that from some of the credit card companies, some of the board members were speaking about that. Activism was the number one topic of conversation, not a shock given the amount of activity that's taking place. Spin-off. How companies should spend cash. Those were the big topics inside the boardroom, and we were having conversations about that in terms of what is it the investors are thinking about, sort of that intersection between the money and the product being the companies and their money being the investors.
Is that bullish for stocks? More activists, more pressure on profitability?
Well, depends on individual companies. It's a near-term potential catalyst for pushing share prices higher in some instances, but not necessarily for the overall market. Which largely reflects this issue.